Hi folks, it's Adrian's doing to CryptoBirb, Adrian's doing to CMT. I wanted to say charter market technician, speaking to you straight from Ericeira, from beautiful place, Surfers Village spot in Portugal. Beautiful, shiny, sunny weather. And well, we're discussing volatile days, potential turnaround days as we head into slower summer period. And we're going to discuss and investigate deeper into the stock market, into traditional finance, as well as Bitcoin, and where is Bitcoin going? What's next? Let's dive deep into the charts. And you're ready to hear this and more. Make sure to stay tuned because we're going there right in a second. Ladies and gentlemen, again, CryptoBirb, Adrian's Dunchik. Thank you so much for all your kind comments. This is Daily PDI. Welcome on board. This is Tragic Garlic. Hey, familiar name. I love this name. I told you that many times. I think Tragic Garlic. This is pretty cool. Well, greetings from Zurich. Absolutely loves this CryptoBirb deep dive. Really excited to be here. Thank you so much. I really love your positivity. Keep up doing that, because by being here you are an early winner, and congratulations to everybody who's watching that. If you're watching that on YouTube, well, that's even better. Make sure to stay subscribed, because there's a whole amount of content coming in on a very often basis, frequent basis, and we are about to ramp it up even further and deeper with so much more value. So without further ado, let's have a deep dive basically into the charts, right? Let's give a little bit of a summary. And there is this message that you might want to be aware, right? Because basically I've created this thread, this live message thread. I posted at approximately at 1:11 a.m. of my Portuguese time, right after the market close for Bitcoin. However, it does regard the warning, and the warning regards actually my mistaken framing that as a triple witching. That's not a triple witching day. Triple witching day happens when there's a quarterly expiry of options. And then the futures contracts basically happening at the end of every quarter, the third Friday of the closing month of a quarter, right? So for every third Friday of March, third Friday of June, third Friday of September, third Friday of December, right? This is these are the called witching days, right? Those are not kind of like the triple witching days that align the monthly and the quarterly. Here we're talking about the monthly July expiration day, and the July expiration day is very I should say significant and important for many reasons, right? I'm actually holding right now in my hands a copy of Stock Traders Almanac. Here is an excellent book by my good friend Chef Hirsch that I use, that I personally often read. It's an amazing journal with so much information about the history of the stock markets. That's how I know that the pre-election years are basically the best performing years on the record. In the 83 out of 84 odds are winning for the bull market right there, right? So having friends and assistance from people like Jeff Hirsch up here, we can actually get warned. And the warning for today comes, let me quote, this is page, it's going to be page 73. And it says, July expiration date, though down 15 of last 22, minus 4.6% in 2002, minus 2.5% in 2010. And the Dow Jones only closed 19% of the time higher. In the last 22 years, it closed only 19% higher than it actually opened, right? So only, well, once every 5 times, it would close higher than it opened, right? It means that 80% of the time, approximately, it's bearish, right? It closes lower. S&P 500 closes higher 23.8% of the time, right? So means translates that 76% of the time, basically, it closes lower, right? And NASDAQ, 14.3%, okay, closes higher than it opens. So basically 85% of the time closes lower. So it means that those days are marked as a very bearish day, with bearish seasonality. Mark attention up here. And there are so many reasons, right? We're looking at overall all the stretch trends after massive rallies. This year is bullish and the bull market all the way. There is not a single tiniest question about that. And anybody who's saying it's a bear market basically leaves stock in 2022, because for those who are awakened, for those who are woken up, we are midway through 2023 and we're bullish. This is the bear markets, do not let you see Microsoft reaching new all-time highs, do not let you see XLK communicate, the technology stocks, the Nasdaq basically pulling off like crazy, S&P 500 bouncing off severely, Dow Jones breaking new highs, right? Those are not the things that you see in the bear market, and well, we've been seeing them all the year round so far. So I'm sorry to disappoint any bears out there. It doesn't mean, however, it doesn't determine and guarantee anything for the future, right? I'm just stating a fact. I'm just stating, relying on something that's already happened, and I'm just saying that the bull market is here. It's here. It's in an early preliminary phase. However, it's warming up. It's getting faster, and there is a little bit of a thread that I wrote up here, right? With the big bear. So you know very well. Again, thanks and big shout out to Jeff Hirsch with his excellent Stock Traders Almanac. This is really highly recommended. Yeah, we'll be working with something. We'll be working on something with Jeff. I cannot give you and spoil too many details. We'll see when it gets out. However, you might want to be aware again that this is marked as a bearish day, right? So if you have 85% of the time chances that the market closes bearish, right, then 85% of the chances are a pretty big strike rate, right? This is not something that we would probably want to fade or counter. So at least it's good to be mindful about that. So this is what you can learn out of the July expiration day, right? So Dow Jones, let's actually have a look at the Dow Jones chart right here. Dow Jones, boom. This is going to be the Dow Jones. It's going to be an industrial average. So where are we? Industrial average. We're breaking out to the new highs up here, right? The breakout is confirmed at the bottom, Dow Jones Transportation, which is actually also coming in higher, right? So there is a full alignment. The Dow theory is intact in check, where the averages confirm each other. The bull market trend, this is the primary bull market trend, is actually lifting up stronger, faster, and more aggressively, right? See the transition from early 2023, where it was basically flat, and then it's curved up, and it basically accelerates even faster and faster. We are in the bull market, ladies and gentlemen, by every single mean of it, no matter how we look at it. Plus, there are 83 to 84 chances, 98.8% of chances that this year closes bullish, but higher than it opens. Hence, that term is the bull market history. 84 years of data is not something that we should ignore. So yeah, we're breaking into new highs. So what I was saying actually here was, again, Dow Jones new highs, 35,400s, breaker confirmed, sharp 200-day trend boost, which is something that I've already discussed. Transportation confirms Dow theory intact, down, but this is careful watching. Down 15 of last 22 per Jeff Hirsch analysis, like I said. So down 15 times of last 22, this is a lot. This is pretty much, right? So again, be very mindful about that. It doesn't guarantee anything about the future. It doesn't determine anything about the future. However, if the odds are that 15 of the 22 are losing, right? So perhaps you should consider that, take that into consideration. Let's have a look at S&P 500. So the S&P 500, where are we? We printed a little bit of a gravestone doji yesterday, right here at the very peak. This is a gravestone doji, I could call it this way, these high wave doji. However, it looks like a gravestone a little bit. Well, maybe not per se ideal gravestone. However, it is a good candidate for anything between a high wave bearish doji and well, just maybe even a low time frames and reversal out there, right? Because there is a little bit of a closing candle, there is a little bit of a gap that was filled up here, right? And there's another down day, basically. So we have this kind of like a tiny gap of air up here that was not covered by the closing prices, right, or opening prices. So it's a little bit of gappy there. It may be considered as a little bit of an reversal of smaller time frames. There is also, well, arguably some sort of, again, like a bearish candle up there. It's not a dark cloud cover formation. It's not a bearish engulfing, right? However, it's a decent closing solid body to the downside. So that's what's supposed to be ahead. And today's bar is wrapped within the body of a previous candle. That's why we can call it like an inside bar pattern, right? Where the volatility doesn't even leave or exceed the yesterday's closing and opening prices. What it tells me is that the volatility is remitted and the whole price action is consolidated within the yesterday's frames, right? So the market is ranging, and it's ranging tight in a tightening manner. Now, as a result, what it tells me is that this is a Harami pattern, and those Harami patterns can often be met at the local reversal. So again, of course, there is no guarantee anything about the future. However, it might be worth appreciating that we've rallied basically from 3500s all the way to 4500s, right? So 30, 44, 45 through 25 is basically, what is it, 28%, if I'm not mistaken, right? So it's a very, very solid number, very solid portion of it, just a matter of couple of months. So if we go ahead and have a look basically at the performance chart, right, what it's going to tell us, if we have it at the performance chart, then on the year-to-date basis, I think it's going to be how many? 155 up there, boom, 137. Let it be. So what we're going to see is that first of all, the technology, like I said, is leading the whole package. Communication services 36% year to date, 43.58% in just 7 months, right? Not even, well, 6-7 months up there. Consumer discretionary 33%, which is a cyclical sector, which basically accelerates and decides about the bull market and the bear market. The next one is industrials, materials, real estate, financial, so all the real estate sensitive, on the interest rate sensitive staples, energy, healthcare, and utilities. So have a look. We are looking at the bearish stocks, the ones that performed best the last year, at the far end of the opposite negative extreme of the performers, and the ones that are risk offensive, the ones that are the best performing, the most risk aggressive, the ones that push the bull market are the heavy peak. You're talking about the 50 percentage points basically up there, right, of difference. This is a huge, fast gap. So there's a distinct leadership from the risk offensive stocks, risk cyclicals, determining the bull market, and the ones that should be performing badly in the bear market and the bull market are actually performing badly, which reassures the whole bull market mess. So yeah, industrials bullish, S&P 500 bullish. However, again, the trend accelerating. However, you might want to be aware that the overall odds for August and September are not the strongest ones, right? These are not the strongest ones. So if we have a look at the season X, this should give us a little bit of a well, let's have a look at S&P 500. What it's going to tell us, right? Let's so S&P 500, what is it going to be? Let it load. Right? Let's, okay, so it's going to be S&P 500. Maybe let's try to search this way. Come on. There we go, 95 years of data, right? So that's the one that we're looking at. So 95 years of data. Again, 95 years of data. This is a lot, right? And we are talking basically about the most negative month being September. So September, the Mondays are the worst, clearly, right? September is the only, well, not the only, but the most negative month on the stock side, right? And stocks often actually bottom out during September, late Q3, September and October. That it typically puts in the bottom, just like we see over here, right? Again, we are slowing. We're on the declining slope. The July summer rally actually ends, is the weakest of them all, and it often ends with this July expiration day, the third Friday of July. So this is what we're seeing, everybody, right? So again, be mindful of that, right? So the S&P 500 news, 4,600 barrier, gravestone doji on top, caution. Well, it's a little bit of a gravestone doji, somewhere maybe in between. I wouldn't necessarily pinpoint is it an ideal gravestone doji. However, it nicely corresponds with the overall potential bearish implications in the short term, just like I referred to it, right? Bull market speeds up, which is not because I say so, but because I look at the trend, and this is a bull market trend. And well, guess what? It speeds up, right? It gets faster. It was a couple of months ago, it was flat. Right now, it's basically kind of like, again, the curve, the slope is accelerating, right? And when you have to redraw those trend lines a couple of times, the market is basically, getting faster and faster and faster. This is a sign of momentum. This is a sign of strength, right? When it accelerates and becomes faster and faster and stronger. So you want to see something like that. And the support, 200-day support, is at 40.52 right now. This may serve as a frame of reference for traders expecting to with those areas. However, please know that this is a dynamic number, right? It inclines, it makes high highs, high lows up there, and it's in a bullish mode. So if we go further, like I said, tomorrow up 23.8% of the time the last 21 years, Nasdaq down almost 86% of the time. That's not something that we should ignore. So strong odds that we're actually finishing the bullish rally right now, right? Again, no guarantees. However, you might want to be aware of that. And this switching day, this actual third Friday of the month, in this case, is marked as super bearish, right? And typically the equity and index options, as well as the futures index futures expirations for the derivatives, translates to increased volatility. Increased volatility translates to bigger risk. Bigger risk translates to higher chances of losing money or getting stopped, or basically losing the profit, losing money, whatever you frame it. It's a measure of risk, right? Volatility is a measure of risk. So perhaps consider closing it, some positions, right, if they are still in profit. Just maybe, if there is some turbulence, maybe it would not be reasonable to keep and play that and right, just as if you would do in a full-blown out bull phase mode. Energy market, right? Underperforms S&P 500. Bull market still intact, but slowing massively. Price calling around the mean. So consolidating in a form of a symmetrical triangle coil, right? We're going to have a look at it in a second. Expect volatile breakout, dropping XLE energy sector ETF bullish prices. Could indicate bullishness for Bitcoin, for risk assets, right? It's actually fairly simple, because the more money you pay for the energy, the less money you have for investments, for good, considerable investments up there. However, the more money you have in your pocket, the lower the energy prices. The energy works like a hidden tax. The more money you pay, the less money you have on your hands. The more money you have on your hands, however, the more money you can spend on goods, on durable goods, on cars, on something that is more expensive, on something that you can only spend when you feel good about it and relaxed about the future. Also, in investments on the actual Bitcoin. Plus, the cheaper energy is good, profitable for the miners, because it lowers their actual profitability threshold that they need to break even in order to become profitable and float above the water, right? So again, here we are talking about the XLE versus S&P 500 ratio. It's been trending down since 2023, or even before, from November, from the actual market bottom last year, right? And we've been moving in a consistent downward trend on the relative strength ratio. Why is it important to measure relative strength ratio? Well, it's important because it tells you about the overall preference of one versus another, one relatively to another. So if the S&P 500 is an obvious financial benchmark, it's an index of how the stock market performs, then comparing the XLE, the energy sector, for how it trades against the benchmark, gives us a unified view on whether it's a good choice or a bad choice. And the momentum principle reassures that the outperforming assets will continue to outperform, and that the underperforming assets will continue to underperform. And because of that, because of this overall trends persistent, that it tends to persist and move in one direction longer than not, we can be more, well, I don't want to say sure, however, we can be more expecting and anticipating of the trend continuation, right? So obviously the trend has slowed, like I said, significantly. We are not in a clear bull market mode anymore. Perhaps on the average still yes, but it's super sluggish now, right? Because we're not making new highs. If you have a look, right, we're just chopped in this local range, basically between 60 to 63 points up there, and 92 from the top, right? So we are just chopping around those well-framed boundaries, Even though it's in the upper half of the boundary, please know that we are actually spending more and more time below the 200-day moving average, which represents the bull market trend, right? So what it tells me is that the price tells you that versus the S&P 500, it's not so popular anymore. The best performer of 2022 is actually one of the worst performers of 2023. So the preference is not there anymore on the defensive side of the market. The preference is in the offensive side of the market, and we're looking basically at the obvious, I should say, preference, the very strong, vivid preference of the investors to choose the S&P 500, which is cyclical risky stock index, versus the energy, right? So if the demand is taken away from the market, the market will have much less support in the prices, right? And there's much less cushion below the price, basically, to support the prices to stay above. So arguably, again, the more time we spend below the 200-day moving average, not only slows down the whole average, but it also brings more supply pressures. And I would not be surprised if we eventually see the prices catch up with the with the actual price action, right? Because just like we've seen in the past many times, that relative strength ratio breakouts, they often precede the price breakouts, right? So the ratio breakout actually could give you a bottom entry, earlier than anything that price informs. So here again, we were looking at the signals for the breakdown on the relative strength ratio, and here the price is not yet reflecting that. It might happen. So about the background noises, those are my birds chirping, my parrots, my lucky parrots. So the more time the market spends, basically below the 200-day average, so okay, so sorry. So the more I'm just checking about, because my internet connection seems to be failing right now. So if we are up here discussing the energy sector, we should probably be aware that the decreasing energy prices could be bullish for Bitcoin, and that's what matters potentially, right? So if we go further, well, the USD, the new yearly lows below 100, bear market getting stronger, resistance 101, 102, 102.5 points, 104 points up here, right? Volatile reaction from FOMC expected. That is something that we should probably be mindful of. Then if we have USD basically chart up there, well, what are we going to have a look at? Hopefully it's gonna show off and pop up. The USD, give us the USD. Where's it gonna be? It's gonna be under my watch list. There we go, right? So the dollar up here, it's not necessarily the most bearish, but it's still kind of like floating above the 50-month average. However, you might want to be aware that the bear market is actually spreading faster and stronger, right? So if we have a quick market summary in the stock charts up there, what we're going to have a look at is that the dollar actually, again, is performing to the downside. This is a dollar chart, right? And the upper red curve represents the bear market. It declines. The primary trend declines, and it declines faster at an increasing pace. What it tells me that the bear market accelerates, and all the averages are right now pointing down. The 20-day average down following the recent crash below 100 points, which is critical magical level of interest. 102 points up there, for the 50-day frame of reference. So all the averages are pointing down. The bear market accelerates. That's not something that is I would call bullish. Even though even if the FOMC presents a bearish, hawkish establishment for the one more rate hike, it seems that it's not enough probably to basically reverse the dollar. The dollar seems to be done at this point, right? And since we've skipped already, the interest rate hikes, that's happened already. Then we may actually be heading to a similar situation in the near future, right? So having the dollar actually being in the bear market is bullish for the risk assets, right? The cheaper the dollar, the more money basically is going to be stored in the risk assets, right? Because cheaper dollar doesn't offer much leverage anymore to those who want to store capital somewhere. Then the yields, right? The long maturities, basically that 10-year interest rates are bullish but slowing. The bull market is kind of like exhausting. It seems the yield curve deepest since it's been in a long time, right? So if you have a look at the yield curve inversion, we're basically at minus 0.95, minus 0.108, 1.08, basically on the negative side. We are the deepest we've been since 1980s. That's not every single time that there would be a recession. It would be previously backed and preceded by the actual yield curve inversion, and that's the deepest it's been since 1980s, right? So it's going to be very, very difficult, I'd say, to escape the recession at all. right? However, that the recession doesn't mean the markets are bearish. Perhaps there's a short-term reaction to the downside, maybe, who knows? I cannot predict the future. However, most of the time, the markets pump during the recession, especially into later phase of the recession. So we're going to see and have a look about that, right? So what's the tip again? Beware of the volatility coming from the options and index futures expiry up there. It's again not triple bitching, not triple bitching, triple witching. I actually, like I said, recognized and made a mistake up here. So it's these only happen quarterly. Be mindful about that. It's just the third Friday of a month. However, it's a market as a super bearish one, right? And that's about it, right? So if you go ahead to where Bitcoin stands in all of it, right? So what we're going to have a look at is that Bitcoin is, of course, very sensitive to the dollar. Bitcoin is very sensitive to the energy. Like I said, we want to be one with what Bitcoin does up here, even though it's kind of like, again, just hovering right now around the range lows of the consolidation pattern following this massive breakout. The consolidation of the previous resistance, even after breaking the new highs, to new highs, is not bearish. It's bullish in its own. $26,000 support right now by the 200-day moving average. Just see how beautiful, clear, and clean and distinct this upward trend is, right? So we only had the 2-3 month period in the 2023 this year in the first quarter when Bitcoin was flat on average, right? There was this massive, of course, the FTX crash right there, right? And then it kind of like reverted the crash and it was bullish. So on average, the market was neutral. But then, of course, with the Burb Pro, you could have got access, way early in advance in the second week of January, rather than waiting for 2-3 months to get a confirmation. The average 200 bull market trend inclines aggressively and it inclines in a beautiful trend line manner. So if I were to draw any trend line, this is the trend line, literally, right? The market is giving you a trend line. You don't need to write or draw anything. The market is giving you the most beautiful, clean trend line that you could ask for. So up there, bullish consolidation, that's what I would call to it, right? However, you might want to be aware, you might want to keep the track of those local lower timeframes, right? Because what's happening up here after the consolidation is a question. We don't know which way it's going to break. Perhaps again there's some turbulence. Perhaps there's some news that is going to make it crack open in one direction or another. If it breaks to the downside, I wouldn't be surprised if it goes down to 26,000 or 27,000. Again, the word is not ideal. There are lots of traps and lots of imperfections. So maybe we slip lower. Maybe we slip to 26,000. If all that I know, if we get the test of 26,000, it's going to be a perfect opportunity to purchase, right? Because the buying on the recurring touch points of the 200-day moving average trend, this is something that we probably want to buy, right? At least for the long term. And plus, this is not magical, right? So it doesn't happen that if you buy, on the trend line on the next minute, you're basically wake up rich, right? So it's not like you touch it with a magic wand. Right? That's not what happens. What happens is that you need a lot of patience. However, if you have this patience and if you have as a fact this rising bull market trend that is accelerating, getting stronger, getting faster, then you might want to be aware that buying into increasingly stronger bullish market is typically yielding bullish returns and positive returns, right? So that's something to probably take care of, take advantage of. So again, if it breaks bullish, the trading range size up here is from 29,500s to 31,800s. That gives you roughly 2,300 target, right? So 2,300 target added on top of this one is gonna take you basically to 3,400s up here, right? So 3,400s and maybe the actual breakout target, mid 3,400s, 34,000s. It's going to be potential upward breakout if we have it up there. Again, just even though it doesn't necessarily need to make sense because traders believe it makes sense because they read a book or this is what technical analysis Bible says, whatever. If we all act in a similar manner, this may cause this self-fulfilling prophecy and make it actually shift this way in this direction. So right there, in case there is a breakout, same way, 2,300 lower is going to be, 27,200s, right? 27,200s may be the low, 27,000 may be the actual point of reference, which would make, of course, a lot of sense as well. However, yeah, that's it. The market doesn't necessarily need to make much sense, right? That's our trapped way of thinking that the market needs to make sense. In fact, anything that makes sense, as Daniel Kahneman, the great novelist at behavioral economy, novelist would say that it's only our faulty internal signal building the confidence in something that we understand the word in retrospective. We don't understand the world as it's happening because it's too complex. However, we trick and fool ourselves that we understand the world only in retrospective, right? Only in hindsight. Everything is obvious in hindsight. Nothing is obvious at the very present moment. So I'm not going to give you the very direct answer if it's going to break out or down, simply because I don't know, and there's not a single person in the world that would know. However, if it breaks to the upside, then there are going to be a whole army of people claiming, "Oh yeah, I knew it would break to the upside." Fuck no, this is bullshit, right? So that doesn't work like that. Sorry. So yeah, no simple answers. The markets are not simple. The markets are chaotic, full of entropy, full of chaos, full of chaos that you cannot get rid of. At times, the market reshuffles. There is a president slipping. That there are presidential assassinations. There are many different wars and COVIDs that can flip the market upside down, flip the tables around, make the bullish things bearish, and make the bearish things the most bullish thing in the world. And it doesn't matter because it's happening on the right-hand side. So we don't know what's happening on the right-hand side. It's full of opinions, it's full of biases and errors. However, we for sure what's happening on the left-hand side. And that's the beauty of relying on the facts, on the evidence-based technical analysis that is going to help you frame it in your good performing trading systems. And speaking of trading systems, I'm actually right now out of the position, right? I'm out of the position. Let me get you up here. We released a new version of Fabricator Pro, by the way. I'm going to give you so much more details in the very near future. And my signal has triggered the bearish signal up there, right? Again, it's choppy. It's going to chop around. I'm going to lose a lot small positions in the chop because that's natural for a trend follower, right? I lose 70% of the time. I win only 30% of the time. However, the wins are massive and the losses are small. So this is what helps me become profitable way more than actually trading the choppy range right there. Plus, this range is super choppy. It's low volatility. The volatility is low. The volatility measured by the market technicians is the ATR, and the ATR is well beyond its 50-day moving average. So 50-day trend ATR is actually, the ATR is underperforming its 50-day medium-term trend. So it's not really, it's telling you that the market is overstretched for a long time without a massive breakout, right? Because there is a volatility that is well beyond the average and underperforming and below the average. And it's also not really sustainable for an upward trend. So if there is an uptrend or if there is a downtrend, there needs to be a very explosive movement that is going to significantly spike up the momentum. So right now, probably the moment, again, 77.0 is basically the average daily volatility based on ATR. So at least triple of quad 5 time it, right? So any move bigger than $4,000, $3,500, right? So 2.5K, 3.5K in either direction is going to be decisive. So we probably, because of that, the trend is only going to be reliable, valid, basically in any way. Probably if we break lower immediately in one move or in very sharp, aggressive movement towards $27,000, $28,000, or we can easily break up, towards 34,000 in one target like that, right? So again, if I were to simplify, it's either 26, 27 or 33, 34, right? Nothing in between for too long. That's what I would say. And my systems are currently bearish, right? So I'm off the position. I closed my position on a small loss. That technically is not well, it doesn't matter how it is, right? I frame it as a loss because I got stopped with less money that I had. However, it's an reopened position based on the profit that I generated. So it's just a little bit less profit in practice. Doesn't matter. What does matter is that you are still here. Congratulations to you. And if you're watching that, well, thank you and congratulations. And I've got a present for you. You can sign up for free signals right there. And we have a special official partnership disclosed and fully transparent with our partners at Bybit. They are great and helped us actually helped you get free signals, right? So we have those premium trading signals that we've been giving for many, many years. This is the 6 years actually we're doing with the Birbnest, while 99% of other competitors, other groups, other scam artists basically just evaporated and went out of business. So we're here for the ups and downs, for the bear markets, for the COVIDs, for the wars, for the sideways, for the choppy hell. We are here with you and providing you profitable, tested, back-tested, profitable money-generating signals and calls. And they're to be taken for you for free if you go ahead and fill in the subscription instructions with the thebirbnest.com Bybit app there. Guys, I really appreciate you tuning in. I need to run. If you're watching that again on YouTube, make sure you hit the subscribe button, smash the notification bells on to stay notified every time we put out a new content piece. Hit a like while you're there and drop some comments, because I'll do my best to go through all of your questions along with my team and get those. And shout out to Rick, shout out to David, shout out to Tragic Garlic, shout out to Uriel. Much love up there to you guys, and congratulations, you are winners. Persist, stay strong, God bless you all around, and I see you on the next week. Obrigado.